Namaste and welcome. Look, let's just get straight to it. I gotta ask you a pretty serious question. With the ongoing global conflict, this stubborn inflation we can't seem to shake, and central banks basically walking a tightrope right now, is your portfolio truly prepared for this new reality? Or, are you still investing based on the fundamentals of a world that honestly just doesn't exist anymore? Today, we're cutting through the noise. We are looking at the hard data, the tectonic shifts happening right now in the global markets, and more importantly, how you need to position yourself to actually protect and grow your wealth. I'll be your host and wealth manager today, guiding you through this explainer of some seriously complex market shifts. Look, in an environment like this, defined by geopolitical shocks and wild economic crosscurrents, having a clear, data-driven perspective isn't just a nice-to-have, it is absolutely essential for your financial security. So, let's dive in. All right, here is our roadmap for today. We're going to start with the big picture, the global macro reality. Then we'll look at the K-shaped U.S. economy, dive into earnings and tech dominance, explore emerging markets and credit, and finally, wrap things up with commodities in a state of controlled disorder. Moving right along. To make sense of all this, we're grounding our fundamental analysis today directly in the Amundi Investment Institute's latest global investment views for May 2026. This report is fantastic. It gives us an incredible window into the macroeconomic realities that are shaping institutional investment strategies right at this very moment. First up, Section 1. The global macro reality and these very cautious central banks. So the overarching theme in our base case of slow global economic growth is that central banks have completely shifted their posture, right? They are remaining highly cautious, strictly reactive, and absolutely not preemptive. The days of easy, free-flowing liquidity, yeah, those are well behind us. But what's absolutely crucial to understand here is that the probabilities for our downside scenario have shot up. Markets are no longer looking at the ongoing conflict in the Middle East as just a one-off shock. It is the new ongoing reality. And the persistence of this crisis, especially how it hits energy, well, that matters far more to your portfolio than the initial shock itself. We are looking at something that could easily evolve into a full-blown macro-financial event. So as a smart investor, you're probably wondering, what are the actual triggers that would force us to pivot our strategy? Well, we are watching 4 key factors like a hawk. First, the length of supply disruptions in the Gulf. Second, exactly how much of this crisis passes through to energy and transport costs. Third, if companies can't pass those costs onto the consumer, we are going to see severely squeezed corporate margins, and Europe is looking particularly vulnerable there. And finally, any hawkish shift in tone. Literally, if the Fed or the ECB even signal tighter policy, our entire view on bond duration is going to have to flip instantly. And you can see this exact tension causing a massive repricing of monetary policy right here. Notice that distinct upward trajectory? That's the Euribor 12-month rate climbing. Short-term inflation fears have just violently repriced monetary policy expectations. The market is finally waking up to the reality that, hey, higher rates might actually be here for a lot longer than anybody anticipated. All right, let's pivot to Section 2, the K-shaped U.S. economy and the massive consumer divide. We constantly hear this narrative about a completely robust U.S. economy. But underneath that aggregate data, there is a stark, undeniable asymmetry. When you look at the actual human element, U.S. consumer sentiment has plummeted to record lows in recent years. Think about it. Inflation is basically a regressive tax, and it has just completely gutted consumer confidence. It's a striking, honestly jarring contrast to that mainstream narrative of unstoppable American economic growth. So what's driving this huge disconnect? Well, look at this. That plunging sentiment makes perfect sense when you contrast it with wealth distribution. The top 0.1% and the upper brackets are holding onto a staggering, growing share of literally trillions of dollars in wealth. This top tier is basically acting as a buffer for the overall economy, keeping aggregate spending afloat, while the bottom 50%, they are bearing the absolute brutal brunt of this inflation. This, my friends, is a true K-shaped reality. The wealthy are riding the top arm of the K straight up, while everyone else is sliding right down that bottom arm. Moving on to Section 3, earnings, tech, and absolute sector dominance. So with all that going on, where is the smart money actually moving to find reliable growth? The answer is squarely in corporate earnings. When we compare U.S. and European earnings growth projections, we see a remarkably strong start for the beginning of 2026. This fundamental bedrock of corporate profitability, that's exactly what is keeping global equity and credit markets afloat right now, despite all those macroeconomic headwinds we just talked about. But make no mistake, This growth is not evenly distributed. Not at all. Information technology and communication services are the undeniable, absolute drivers of U.S. market earnings right now. I mean, look at this. We are talking about projected 2026 earnings per share growth of well over 40% for IT. That's massive. Technology isn't just a sector anymore, it is literally the fundamental engine powering the entire U.S. market's profitability. Now, obviously, artificial intelligence is this massive long-term driver, but U.S. tech, it's heavily priced for perfection right now. But notice this remarkably low, downward trending weekly correlation between the NASDAQ 100 and the MSCI Asia Pacific Information Technology Index. What does this mean for you? It means Asia is taking a massive prominent role in the AI supply chain, and its tech stocks are diverging from the US. For an investor, this is a beautiful thing. It offers you true geographic and valuation diversification while still letting you capture that explosive AI boom. All right, Section 4, Emerging Markets, Credit, and the Hunt for Resilient Yields. Look, when equities are whipping around with volatility and your cash yields are getting eaten alive by inflation, we absolutely must look to fixed income to find some resilient yields. And the data here is super interesting. Emerging markets have been incredibly resilient, bouncing back super fast from those initial conflict-driven losses. And within that space, Latin America is looking particularly attractive. Why? Because the region offers highly appealing valuations and it acts as an insulated commodity exporter. When the Middle East is facing geopolitical turmoil, resource-rich Latin America provides a really strategic hedge for your portfolio. Now, zooming out to the broader credit market, it definitely retains a strong overall appeal. But the absolute standout opportunity right now, that would be European Union investment grade or IG bonds. They are offering a highly favorable mix of duration and yield. Seriously, if you're looking for stability and reliable income to just anchor your portfolio right now, EU IG bonds are presenting a historically attractive entry point. And just to build on that case for fixed income, take a look at how emerging market bond spreads have remained remarkably contained, even with all these ongoing global conflicts and macro shocks happening in the background. They haven't blown out like we saw back in 2008 or 2020. No, they are offering an incredibly attractive duration-to-yield mix. It really proves that in today's wild market, EM bonds have become a genuine pillar of resilience. Finally, Section 5. Let's talk about commodities in a world of controlled disorder. In a world where paper assets are basically just tossed around by the whims of central banks, physical assets become your anchor. They just do. Gold's fundamentals remain exceptionally strong. It's acting exactly as the structural diversifier you need when geopolitical controlled disorder is the name of the game. And at the exact same time, this AI boom we keep talking about, well, it requires massive physical infrastructure. That's providing incredible tailwinds for industrial metals like copper and aluminum. Tech needs raw materials, period. And commodities are perfectly positioned to capture every bit of that surging demand. My friends, we've covered a lot of ground today. We've journeyed from the highly cautious stance of global central banks straight into the undeniable earnings power of the tech sector, and then looked at the stabilizing force of emerging market credit and physical commodities. The data is crystal clear. We are operating in a landscape of controlled disorder. So I'm going to leave you with this final, absolutely critical thought. Take a hard look at your investments today. Is your portfolio truly sufficiently diversified based on these new macro to micro fundamentals? Or are you just hoping those old rules will somehow still apply? Because let me tell you, the smart money has already adapted. It is time for you to do the same. Thank you so much for joining me on this explainer, and as always, I urge you to invest wisely.